In this lecture, I want to show you how if you already owned 100 shares of Apple, perhaps you bought it at 400 or 450, but now you're concerned that Apple might fall. And you're concerned that it might have a temporary fall. You don't want to sell the stock at this point, but you are looking for a way to hedge this position. So what I have here is this is stock now, you can see, and we are buying, and I'm going to simulate this trade. It might be a little challenging, but let's see. We're going to buy 100 shares because this is stock, this is not option, and you can see that it's stock at $468, approximately somewhere there. And then if we wanted to simulate this trade, this is what a stock position looks like. And then I've also included some bonus material in this course, so please be sure to watch that. Those are short mini courses that address simple things like capital efficiency of stocks versus options, etc. But this is one of the things you're going to see. This is the risk profile of a stock, and you may or may not have realized that when you own stock, you're exposed completely on one side. So if you're long the stock, which means you've bought the stock, then you have exposure on the downside. But let's say you shorted the stock, then you have exposure on the upside. So if Apple starts going up, then you have a problem if you have a short position. And similarly, if you own the stock, then you have some serious exposure if Apple starts to fall. And most investors don't really think about this as exposure. They take it as par for the course, and that's very bad because you have to realize that when you have stock, it's a 50-50 shot. It's going to either go up or down. So that's a pretty high probability of your stock position going against you, and you should always think of ways you can hedge that. You can think of ways you can neutralize that, and that's what we're going to show you in this particular course. So let's say you own this stock position. Your risk profile is a diagonal line going from the bottom left up to the top right. And if you wanted to hedge it for any downside risk, then what would you do? You would think of buying a put option because the put option increases in value as your stock goes down. So let's go take a look at put options, and let's say you wanted to hedge for a period. And again, you'll have to decide that. What is your outlook? Are you concerned that in the next 30 days or 60 days, something might happen to the Apple price because perhaps there's a lawsuit on Apple or there's some other product that's being released? Whatever the case might be, once you decide on the period of your hedge, then you would come to the appropriate strike price, rather the appropriate expiry series. Let's say you're just concerned for the next 30 days, okay? So you would come to the March series and you would look at the price where you bought Apple. So today it's trading at 467. And let's say you bought it at 450. So you're concerned about Apple going below 450 and you would like to protect yourself. Now you can see if you buy a put option, it's going to cost you some money. So if you want to get protection around the 450 level, you should probably buy the 455 put because you're going to have to pay about $8. So after paying $8, you're going to have a hedge from 455 minus 8, which is about 448. So let's say that's the range where you want to start protecting your Apple position. So let's go ahead and buy. I'm going to buy just one contract because we have 100 shares, and I'm going to buy the 455 put in the March series, and I'm going to pay $8.75 for this particular option. Now, if you look at the risk profile, it's going to show you the risk profile of both the stock and the option together. And what you can see now, this is really great. So let me take off the option first. So let's understand. This is the stock. Your stock has unlimited profits to the upside, and it has unlimited losses all the way down to zero. Now, if you add this particular put option, let's see what it does. It takes away the unlimited loss on the downside, and it becomes a flat line. Now, it doesn't matter how much Apple drops, your loss is going to be fixed. your loss is going to be about $2,000. You've basically arrested any downside losses beyond this point, which is that 455 strike price. Now you could do 460, you could do 465, you could do any number of strike prices, depends where you want the protection. And the choice of where you want the protection is going to impact the cost of that protection. So it's just like buying insurance, whether if you have full coverage or if you have third-party coverage for your car, things like that. There are various types of insurance available, and you should see the bonus material that I've attached with this course. I do have a video to show you, or a blog post to show you what this level of insurance means. But basically what you've done is you've arrested the downside losses, but you've maintained the unlimited profit profile on the upside. So let's say you bought this protection, you paid $8.95 for this. So for 100 contracts, you'll pay about $890, let's say $900. Okay, so you bought protection by paying $900 premium, but what you've done is you've still maintained the unlimited profit potential. All you've done is you've arrested any potential losses beyond this point, beyond this 455 level. So that's a great strategy. If you already own stocks, you don't want to sell it yet because you believe in the long-term potential. However, in the short term, you're concerned that the stock might take a beating, and therefore you'd like to protect your stock, and this is one of the best ways you can do that. Always make sure that the number of shares you own and the number of contracts you buy are equivalent. So if you own 500 shares, you should buy 5 contracts. Let's say you own 550 shares, then it's up to you. You can buy 5 contracts or you can buy 6 contracts. But if you wanted to perfectly hedge your stock position, you need to make sure that these two are equal, or the option can be more. But if it's less, then it's a problem. So, all option contracts, each contract is 100 shares. It's a standardized amount for any stock or any ETF in the market. So you can always find a put option contract where you can protect yourself. So that's as far as this course is concerned. I hope this was very helpful to you. This is a combination of about 3 or 4 different courses, which we've condensed into one into Udemy. Then in the next course, you're going to understand the real subtleties of options. So we're going to tackle time decay, implied volatility, the Greeks. There are 4 Greeks: delta, gamma, beta, theta, and vega. And these are extremely important Greeks. You have to, if you want to become a master in options trading, there are a few things that you have to know. There are 3, I would say 3 legs to the stool. One is the Greeks. You have to know the Greeks because the Greeks dictate how your option prices are going to move. The second is profit and loss graphs. So what you're seeing here is a profit and loss graph. Now this might look, you probably got used to these graphs a little bit by now, but these are simple graphs. Once you start tackling complex strategies, these graphs are going to get a little bit more complex. But they're absolutely critical. If you don't understand risk graphs, then you're flying a plane without a map. So the map is the risk graph, and the Greeks are your instrument panel for a pilot. I'll be covering this this analogy in detail in the next course. But these 2 things are absolutely critical. And then there is a third leg to this thing also, and that is more of an art than a science. Every option position is going to get into trouble, or rather, many of your positions are going to get into trouble. See, nobody has a crystal ball to the market. I might know options very well, but if you ask me what is the market going to do tomorrow, I have no idea. And you can ask any of the experts on Wall Street and they're going to tell you the same thing. So markets go up, markets go down, stocks go up, stocks go down. With options, you can put a particular strategy, and that is the beautiful part of options. So you can put a strategy, you can craft a strategy, stick to the strategy, but it doesn't mean that the strategy is going to work. Your position might still get into trouble. And if it gets into trouble, you have to adjust your options. So adjustments to options are the third leg to this tool, which truly will make a option master out of any options trader. Okay, so you need to master the Greeks, you need to master the risk graphs, and you need to master the art of adjustments. And so that, we'll be looking at all of that in future courses, but the next course is going to be on time decay, implied volatility, and the Greeks. And this is absolutely critical. This is the theoretical part of options that you have to master before you move into actual trades. So that's what we're going to do in the next course. I hope this has been enjoyable. If you have any questions, please send me an email at info@optiontiger.com. I look forward to seeing you in the next course. Thank you.